Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest is Nick Legamaro. Nick is the managing director of USANotePro.com, also known as Nick the Note Guy. He created, bought, and sold over 700 mortgage notes in 21 states. He also built and sold creative financing note business to a 100-plus-year-old bank. Nick goes into detail today about notes and why maybe you, even as a passive investor in syndications, why you should consider maybe being the bank, right? Or having some notes as part of your portfolio. I hope you learn a lot and enjoy the show. Nick, welcome to the show. Give us a little more about your business model, who you are, how you got there.
Well, first, thanks for having me on. I'm excited to be here, and hopefully we can shed a little light on what we do. And, primarily I've been in real estate I stopped counting, actually. I stopped counting number of deals, stopped counting a lot of things. As you get older, first of all, it doesn't mean as much anymore. But I started in the early 2000s. I went through the 2008 debacle, lived to talk about it, hear him today. A lot of my friends and associates did not. So I feel like I can speak from a little bit of a position of experience. I wouldn't say it's all positive or negative, but I think it really taught me a lot on where we are today coming out of COVID, on where we can be really focused and structured on. But it's an entirely different monster and animal today than it was there, and we might dive into that a little bit. But my main business today is really on how to be the bank, and what that means is how to act like a bank, and how to invest in high yield, low risk, mortgage notes that are secured by properties. That's what banks do. It's funny because banks tell you what to do with your money, but they don't do anything like they tell you to do. It's sort of do as I say, not as I do, right? And if everybody did what the banks did, they would be making a heck of a lot more than a 2% or less return on a CD, or idle cash sitting in an IRA account that they didn't even know they could actually be the bank. So that's what we do. And we focus a lot on the creative financing aspect of that, on how to create the notes. We talk about how to buy notes, and basically how to just leverage in the portfolio in whatever your investment strategy is, and really just educate on how to be a lien lord, not necessarily a landlord. Although there's nothing wrong with being a landlord, in my opinion, has shifted quite a bit. If you want to know my opinion in the last several months, just because of the way prices have escalated on properties and rents are going to go up. So, but there's a time and place for everything. And I think it's just very prudent to be diversified in whatever it is. You shouldn't be just a buy and fix investor, or just a multifamily, apartment syndicator, or any of that stuff, because I think it's really, really dangerous to put all your eggs in one basket.
No, there's probably listeners that are thinking, well, wait a minute, be the bank. Well, how can I be the bank? That's why the bank's the bank. How can I even think about doing something like that? What does that mean exactly?
Well, really, it's no different than, instead of owning a property, like most people understand what buy and hold is, right? That are in the real estate, whether it's a buy and hold of a commercial building, an apartment complex, or a single family home that they turn into a rental property for cash flow, right? This is I'm holding a note and being a bank. Have you ever had let's just talk about this real basically. Do you have a mortgage, or you ever had a mortgage with on a home?
Of course.
Most people have, right? And let's just say that was with Bank of America, all right? As you own the house, the bank owns the note, right? You have an agreement to pay the bank they lend you money, they pay you pay the bank interest rate, which is amortized, which is, I don't know how they got that to pass whenever that was 50 years ago. But it's a beautiful thing once you understand amortization. So my question to you, Whitney, is how many times have you ever called the bank? First of all, that's my first question for anything.
Not very often.
Not very often, right? You don't
Not about the mortgage.
Not about the mortgage, and you probably don't call them about the roof that starts leaking. You don't call them about when you want to when the HVAC unit no longer works. You don't call them about the plumbing or the foundation or any of that stuff, right? They don't care. you're the owner of the house. Whereas if you're that's the lien lord, right? They control the lien. They have the lien on your property. And if you don't perform, what do? They come out and come back and get the property. Maybe they do a loan modification, or they do, but their investment is extremely well protected. Would you not agree? Because they have the property as collateral. That's why we do it. And when you have that as collateral, which is different than being a landlord, because as a landlord, and there's a lot of moratoriums on evictions right now, depending on what part of the country you're in, and we're not going to get into too much detail on that. I think we all understand what that is. But as a landlord, you're not protected, right? You're not protected in that state. If the tenant doesn't pay you and the state says they don't have to pay you, and they can pay you if they choose, or maybe there's some workout, you don't have any recourse. But as a lender, look, let me say this: banks always get paid. Banks always get paid. They don't sometimes get paid. They don't most of the time get paid. They always get paid. And the reason why they get paid is because they have the security of the asset. Now, they may not get paid today. They might not get paid tomorrow. It might take them a year, because we're in a forbearance, for example, right now. They're not getting paid, but they're accruing an interest on that property. And if you decide not to pay at whatever point in time, guess what? They're going to come and take that property back, or they're going to do something to protect their investment. What banks do. And there's no reason why individuals cannot be the bank. And the way you do that is just like you would go out and find a property to buy. However you go about doing it, whether you buy it through MLS or through a wholesaler or whatever. Like notes are on the market and available for consumption, just like real estate is. The only difference is it's a piece of paper that's secured by the property versus the property itself.
I think most just aren't aware of that. Like they just don't know that, like, that's an option for you to go get into real estate that way.
It's a huge option. And so, the real challenge on notes is the due diligence. And what I mean by that is, how is the paper stack? So let's go back to your example. When you applied for a mortgage with the bank, you had to go and get an underwriting. You had to provide tax returns. You had to provide proof of employment. All these things. They look at your debt to income ratio.
It's much more difficult to get that home mortgage than it is to get a $30-50 million loan on a commercial piece of property.
There's no joke about it. Look, I'm a perfect example of this, and I have no problem sharing it. I cannot go down to any traditional bank and get a mortgage. It's not because I'm a bad dude and I don't pay my bills. It's because I am self-employed. I have multiple companies. I get paid dividends. I don't even get 1099. My employees, that I could have 5 times the amount of cash in the bank to go purchase an asset, and they still won't give me the note. They still won't give me the loan. It's crazy. But they'll give somebody else that is not nearly as qualified on paper, because that's just the compliance in the box that they play in. So here's the funny part about it. And when we talk about this, and this is where I think the opportunity is, it's all in the stacking of the file. And what that means is, when you underwrite a borrower, there's two ways to participate in a mortgage note. One, you can go create the note yourself. And we work with landlords all over the country that are tired of being landlords, that don't want to deal with the renter mentality anymore. And they said, you know what, I still like cash flow, but I'm willing to do that in the form of a note. And so they take that rental property and they convert it to a owner finance, and they go find a buyer, and they get to be the bank. That's number one. And so with that, there's a little bit of risk, and it's more education than is anything else. And you have to underwrite that borrower correctly. And what I mean by that, you need to take an application. You need to verify they are who they say they are. You want to make sure they have employment. They can really, under Dodd-Frank, and we don't want to get into the weeds on this, but there's really only 2 things that you need to do as a small cap lender, which most of these people are. One, you got to prove that the borrower is who they say they are. And number 2, you have to prove that they have the financial capacity to make the payment. That's it. Credit score doesn't have any bearing on whether you want to underwrite that borrower or not. The DTI, the debt to income, doesn't matter. Whether they're self-employed or not doesn't matter. It's just something to take into consideration. So we work a lot of investors that want to be the bank, and they want to create their own mortgage note, and they do it. Now, what I will say is a lot of people don't do that correctly, and it's only a problem. Here's the thing. It's like anything else. It's only a problem if it becomes a problem, right? As long as that borrower pays you, doesn't matter. But if the borrower has been paying you in $100 bills for the last 12 months and now stops paying you, and you're not having it serviced, and you didn't do a lot of things in there, or now you need a lump sum of cash because you want to, because that's the note is a very sellable piece of, it's an asset, right? It's very easy to go sell a note. It's not like selling a stock that you can do in hours, but I can take a mortgage note that has, say, $100,000 unpaid balance. I can turn around and sell that and cash out of it in 7 to 10 days. It's fairly liquid, right? And what's going to determine what I can sell that for is that stack file, that underwriting file, which is everything we talked about, which is all those files, because a note buyer such as myself, or maybe somebody that wants to become a note buyer, because you can either create a note or you can buy it. So regardless if you're creating or buying it, you still want that borrower file to be stacked as good as possible, because that's how you assess the risk on what it is. And if you don't have all the documentation that goes along with it, it's really hard to assess the real true value of that property. So
interesting to think about, like the values in the underwriting file, like what was done to underwrite this? How much do you know?
Because so I'm going to go back to my Ford F-150 example here in a second, but I just want to explain how big the owner finance. First, let me go back. I mean, two stats I want to say. First of all, mortgage rates are historically low right now. That's probably not going to change. They could actually go down to zero. I mean, I don't know what way this government's going to decide to play this. Neither way is probably the best. I mean, pick your poison, right? But right now, mortgage rates are historically low. However, the ability for a borrower to get qualified is extremely difficult. And that's what people don't hear and what they don't say. Here's a perfect example. In March of 2020, right when COVID was hitting, there was 100 borrowers that had been pre-qualified for a mortgage note through a traditional lender like Wells Fargo, Bank of America, Chase, whomever, that were W-2 employees that checked all the boxes, they were approved, okay? Fast forward that to August of 2020, that same 100 borrowers, only about 60, maybe 65% would actually qualify. Nothing's changed in the profile or the borrower. The job didn't change. The earnings didn't change. The DTI didn't change. Nothing changed. So what changed? What changed is how the banks evaluate risk and how they determine what the risk is of that borrower, so that the guidelines get tighter and tighter and tighter. Well, let's be honest. That's not the makeup of America. Makeup of America is people that live more in a we're coming out of COVID. A lot of people have been out of work, and first of all, or they had to do a career change or whatever. Banks don't like any of that, right? So right now, depending on what number you look at, about 60, maybe even as high as 70% of the general population cannot go get a traditional mortgage for one rate, because they don't check all the boxes. Well, that's a huge number. So where do those people go to? Well, they got to go to owner finance, all right? Seller carryback.
How do you make that connection? How do they find somebody like yourself, or how do you find them?
You got to make it that you got to make them aware that you're there. Like you go open a brand new Italian restaurant, you might be able to have the best Italian food in the world, but if you don't get that message out that you're there, you're going to go out of business real quick, because no one's going to come in to buy your food. Well, that's the same thing. So, the seller carryback market, and this is really, I think, really an important number. The seller carry market is continue to go up year after year. And what I mean by seller carry market, owner financing, private lending, and this is all mortgage notes that are created each year that are not written by Chase, Fargo, Bank of America. Take a guess on how big that market is. Just take a swag.
I have no idea.
Yeah, most people don't. And I would argue you're fairly sophisticated and knowledgeable individual, and most of the people listening are far better off than people that don't listen. It's about a $25 billion industry.
Wow.
$25 billion with a B. Okay. I don't even know how many zeros are in a billion, to be quite honest with you. It's a big number. Okay. Right. 25 billion. That's all the notes that are written every year by what I would call mom and pops that go on and create their own financing. They're just tired landlords. They're people that moved out of their house and went downsized, and now they made their property available, for seller carryback. Maybe they couldn't sell it at one time. Maybe it needed repairs, and they had to do it so that the tenant, or not the tenant, maybe the tenant bought it, but the new owner was going to do some sweat equity and make it in. $25 billion. So what happens? So that's the other way that we make the notes available for consumption is we go and buy those notes, for example, and then we got to go back and fix them just like you would fix a property, and you got to fix them and you got to bring them in house and you got to make sure they're stacked correctly. And I want to go back to my Ford F-150 example. I'm in Texas. I don't drive a truck anymore. I don't really. That was when I was doing construction, but you could have two identical Ford F-150 pickup trucks that are both 2015. They both have 50,000 miles. They're both white with tan interior. Okay. But the difference between the two trucks is one has been beat up because it's been used every day on the work. The paint is all scratched up. There's door dings all over it. The kids have drawn with crayons or markers on the back seat of the car. It's never had an oil change. And, that's it. The other one is pristine. And it's had maintenance every day. It's been well kept of. It's been kept in the garage. There's no scratches, no dings. Same truck, different outcome. Well, mortgage notes are no different. They're no different. So you got, when people go, how much will you pay for how much is a note worth? Well, it depends. It depends on what condition is the note in. Is there a lot of scratches and dents on it, right? Was there an application taken, for example? Was it serviced by a third-party servicing company? Was it underwritten by a mortgage loan originator? Was there actually a contract? Is it a contract for deed or a mortgage deed of trust? Those are all factors that you need to take into consider when you're looking to buy a note. But here's the best part of it. You don't need to know any of that stuff. You just need to know that somebody needs to look at that and make sure that file is stacked correctly. I look at very few of these files myself. Personally, I used to do it, done hundreds and hundreds of these, but now you can have that outsourced and make sure that that's stacked correctly, just like you would go and do anything else. So
yeah, I would say, Nick, many listeners are thinking, oh, wait a minute, there's no way I can figure all that out or do the underwriting or whatnot. It's interesting to talk about there's a third party that you can even hire to do that for you. But I wanted to ask you, speak to the investor, the passive investor that's listening right now thinking, you know what, this may be a good way for me to diversify a little bit. What are some expected returns, that an investor should expect, and how do they get paid? When do they get paid? What's the time for the hold period? Things like that.
So it depends, which is a very vague answer, and it really depends on what an asset or a property in Dallas, Texas, is not the same as Cleveland, Ohio. I don't care if they're both $100,000, right? A contract for deed is not the same as a deed of trust. The borrower underwriting file is a big factor. How long has the mortgage been in place, for example? What is the true value of the property? What's the loan to value that the borrower has? The investment, the value to buy. So those are all kinds of factors that need to look into consideration. However, we usually are seeing, and the other thing is you got to keep in mind is that you're buying this at a discount relative to the value of the property. So you let's just say the note is worth $100,000. That's the unpaid principal balance. Okay. The property is worth $150,000. Okay. So even if you're buying that note at say 90% or 95% of UPB, say you buy it at $95,000 because you get a little bit of discount, and the discount is really predicated on how much the interest expense is. If somebody wrote the note at 3%, that discount's going to be really a lot because we want to get that yield up in the 6 to 7 minimum, and it could go as high as 10 or 12. Just depends on the asset and how it's written. Most of the stuff that we write and we sell is in that 6 to 8%, but it's a really good secured asset. Because remember, the difference between this investment and buying the stocks or anything else, it's secured. It's secured by the asset, which is, so what is I don't know how some people perceive that to be. For me, it's all about capital preservation for me.
That's right.
Is more so than it is about building. So yeah. I'm willing to, for me personally, now I obviously am extremely knowledgeable when it comes to mortgage notes, but for me, I look at this in the same category as a bond or a CD or something like that, because those are pretty much guaranteed returns, right? And this is too, but like I said, you may not get paid today, you might not get paid tomorrow, but you will get paid. And that's why having a servicing company, let's go back on how you get paid on this. So we always want our notes to be serviced by a third-party servicing company. And all the third-party servicing company is where the borrower makes the payment. They make the payment. Like we talked about the mortgage that you had with whoever. Like I used to have a Bank of America note, and then my note got sold multiple times. And you get a hello goodbye letter in the mail. And what that means is, hello, I am FCI or August REI or whoever the servicer is. We are now servicing your note because it came over from Chase because Chase sold the note. So that goes into the servicer. Now you make that payment instead of making the Chase, you're making it to say August REI. So now what happens is, and this is where the buyer, in the note investor, the borrower, I should say, and the note buyer come into play. So the borrower makes that payment of the PITI, which is the principal, interest, taxes, and insurance, into the servicing company. The servicing company collects, let's say it's $1,000, okay? And I'm just going to use round numbers. Let's say $1,000 gets escrowed for taxes and $1,000 gets escrowed for insurance. Okay, that leaves $800. Okay, so that the third party processor collects the money, they escrow the $200. The other remaining $800 goes to the bank or the lender, which is me or you or whoever has the note, and that money gets transferred into their account. And it's all, there's no checks, it's just managed through an online lender portal. You can see all that. And then what the cool part about it is that when that note goes into a default status, if it does, maybe it's a slow pay, maybe it's late pays. That's when the servicer comes in and steps in and acts on behalf of the lender to try to get that back to performing status. So you might not even know about it. Does that happen? Well,
yeah, no, it's very good information. I wanted to talk to the passive investor who's thinking, I still don't think I can figure all this out, or I want to be completely passive. Are you syndicating deals like this? Are there operators that are syndicating, notes? Or, can you invest with other people that are, doing the short this? What does that look like?
The short answer is yes. We don't do it very often because here's the thing about it, is that all the notes are independent of each other, right? So it's not like we go build a fund of, say, $1 million and you invest in the fund and you have a fractionalized piece of that note, right? So the mortgage note is the individuals, they own 100% of it, right? So if I have a $100,000 note and you want to be the buyer of it and we agree to sell it to you for $95,000, then there's a purchase sale agreement and you get the note and there's a collateral assignment. We notify the thing, and now you get the original documents, and now you're getting paid on it. It's your asset at that point in time. So it can be done. We don't do a lot of it, but we work with people that want to buy notes all the time, and we want to find out, because the challenge is that everybody's got a different appetite for risk, right? Let's be honest, right? Some people want to say, I just want to preserve. I was just in a meeting in Florida last week. And I was speaking at a conference, and a lady came up to me afterward and says, we got $1 million sitting in the bank right now, and we don't know what to do with it. And I don't know if she said it came from PPP and it was forgiven or something. It's like, okay, so is that a high risk? You want high risk or do you want low risk? You want capital preservation, or you really want to just roll the dice and see if you can double the money? And you got to answer those questions for yourself. But the mortgage notes, for me, here's where I think the two biggest opportunities are for a potential passive investor, right? One is in IRA accounts, self-directed IRAs, SIDRAs, Roths, whatever they are. Maybe they're HSA accounts, because that money is just sitting there idle for the most part. And that's a great investment opportunity because you don't necessarily need the cash today. That's number one. The other two is that we do it a lot with landlords that like cash flow, but just don't have the bandwidth to manage a tenant because they're too small. They only have one, maybe two properties, and unless you have a lot of properties, it's really, really hard to be efficient and scale and have efficiency in a if you only have a couple of rentals. That's my experience. I personally don't have rentals, not by choice.
Yeah. I do. Well, speak to how, let's say real estate prices, interest rates, things like that going up. How does that affect this type of business model? What do you see happening, say, over the next 6 to 12 months in the note buying business?
Well, I just saw futures on lumber. That's coming down. So I don't know where that's going to take things. Hopefully that'll keep prices level. it's a weird thing right now because the inventory is perceived to be low. It probably is low to a certain extent, but this inflation that we're getting ready to go through, it's just driving all these prices up. What's going to happen is that prices are going to go up, but that doesn't mean that everybody's going to be able to afford to buy. So it's about what goes up comes down. I've been doing this too long to know. I don't get it. Here's how I would say this. If you're in real estate, it doesn't matter what the market is really, because if it's a buyer's market and you're a buyer, that's great. But if you're a seller, it's not good, right? And if it's a seller's market and you're a seller, that's great. But if you're a buyer, it's not so good. Well, I don't know how many people are in real estate that are specifically sellers or specifically buyers, but I do both. Most people do both. I have to buy before I can sell. I have to sell before I can go buy again, right? So you're on both sides of the fence anyway. It just, some might be a little bit easier as a result. We're coming out of forbearance right now, and there's going to be opportunity to help people out. I don't know. I just continue just to look at things in a very small window, in a 60 to 90 day window, and not get too carried away on what happened in the past and where we're going in the future, and know that there's a way to solve that problem or equation at that particular point in time. And not only that, these numbers that we see, everything is nationalized, right? Everything is a national number. Well, the problem with that is it's not national. And it's not even state anymore. It's local. It's almost down to the zip code level. So some zip codes could be doing really, really good, and other zip codes could be doing really, really bad, but it could be in a good state. So I just think you just got to really understand your numbers and know where you want to go with it, and just, heed that warning, if you would.
Yeah, well, no doubt, Nick. Definitely a topic we could probably talk about all day.
Yeah, I know. That's why I don't want to go too off on a tangent.
Tell us, how do you like to give back?
Well, I like to give back by just I'm all about collaboration, not competition. So I like sharing what we're talking about now. People be able to reach out to me or to us at USA Note Pro if they have a note they want to buy or they want to learn how to sell or create. We have a lot of educational material out there. I do a lot of stuff, and we're starting to do more on some of our social media, really just to get involved. It's really about education. And for me, that's probably the biggest thing I can tell people is that don't be cheap with your education. When I started in 2000, there was none of this. There was no podcast. There was no YouTube. There was no data that you could go buy that helped us facilitate and speed up the process. You had to go down to the courthouse to get any information. And the foreclosure list, if you did, came on a printout, right? Now you have all this opportunity. And, I always tell people, don't learn from your mistakes. That's stupid. Learn from other people's mistakes and use that as a way to get yourself further down. I spend hundreds of thousands of dollars a year on my education. And I would say that I'm a fairly seasoned real estate investor. I've created over 700 mortgage notes myself. I've done over 1,100 transactions, and I still, to this day, go to masterminds and I educate and I listen to what other people have to say, because that is the beauty of where we are in this technology phase of what we're in. And there's so much that's available for no cost. You don't charge for your podcast. You can go look at mortgage. You can go on YouTube right now and look up how to buy a mortgage note or how to sell a mortgage note, or what.
Right.
And you can
no
learn
doubt
how to do all of that. So
definitely tons of places to get some free resources.
Absolutely.
We all need plenty of mentors as well.
Yeah.
Nick, how can people get in touch with you specifically and learn more about you?
Yeah, so they can go to usanotepro.com, usanotepro.com. That's our main website that funnels to a couple other things, but it's mainly for notes, and we're used when we look to buy notes, when we look to sell notes, we create notes, we put modeling up there of deals and no deals. Something like I'll end up posting probably this podcast on there so they can go back and review some of the stuff that we've done before as guests on other shows. And then we have some ebooks on there they can go and download, and just reach out and just, if they want to be an investor, we can help with that. If they want to look at just being create their own because they have a property. We can do that too. I mean, at this stage in my career, it's all about giving back and helping. And it just tickles me when I talk to so many brilliant minds that have no idea that what a B in the bank is and what a mortgage note is and how that works. And when you really run the numbers, it's hard to compare apples to oranges sometimes. Because cash flow is not all cash flow. I don't get depreciation. That's the biggest argument I hear. Well, you don't get depreciation. Well, you're right. Banks don't get depreciation either, and I don't think they give a rip about it, right? Let's be honest. And depreciation doesn't last forever. And you got to figure out what to do with it when it runs out, right? So it's not all, rainbows and butterflies, right? And you got to be able to solve those problems. And
For sure.
That's just sort of why we do it, and hope I can help other people learn and be successful in holding notes, because it's really truly passive. It's about as passive as you're going to get.
Sounds very passive. Like just the example I thought of you asking, how many times have I called the bank? I think that's a great example just to think through that a little bit. And I hope people reach out to you, Nick. Again, thank you.
Please do.
Being a guest on the show and helping us think through, maybe adding notes to our portfolio. Again, I think raising awareness is a big thing.
I think that's the key. It's just awareness. It might not be, because look, if I was 25 years old, I might have a whole different perspective on what I'm talking about right now, but I'm not. I'm not 25, I'm older. I'm not going to tell you all that. Now, I'm 57 next week. So I've been there and I've done that. And there's certain things that I like in my life that other people are okay not having. And there's other people that like to dig a little deeper, work a little harder, which is great. To each their own. But I think what I want to just educate and share with people is that there's more than one way to generate cash flow, and there's more than one way to invest in real estate, because you're not going to see this on HGTV or Fix and Flop,
right?
Or, all this stuff. That's not I'm not going to be able to glamorize mortgage note investing on a A&E special. It ain't going to happen. So it doesn't mean it's not good. It just means that people just aren't aware. So hope that helps out.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.